Nvidia CEO Jensen Huang just sat down with CNBC's Jim Cramer, and what he said could completely change how you look at AI and the future of tech investing. He made it clear that Nvidia's growth is not slowing down, it is actually accelerating at a much larger scale, driven by the next wave of artificial intelligence, especially agentic AI. In this video, I'm going to show you the clip from that interview, then I'll break down exactly what Jensen really meant and what most people are missing. And if you feel like you missed the Nvidia run, don't worry, because I'll also walk you through two tech stocks that could be the next big winners. Make sure to hit the like button, share this video, and drop your thoughts in the comments. And subscribe so you do not miss the next major investing opportunity. Let's hear what Jensen Huang had to say.
Jensen, I do want to point out, someone said to me the stock's down 30 cents. Your stock's up 22,000% in the last decade. Should we care about the last half hour?
Well, I guess we all do. Our growth is accelerating at a larger scale. That's surprising for people. And the end markets are really growing. We've reached this point in AI called the inflection of inference. And so we've reached the inference inflection. And so, our growth is accelerating. We would love to see everybody enjoy it.
Well, people got a little trapped by the 500 billion to a trillion, and I like that, over 2025, 2027. What trapped me was that when you said, when we were talking around Michael Dell yesterday, that Jim, do you remember when I told you that ChatGPT could be big? And I said, well, yeah, I do, 10 years ago. And he goes, NemoClaw. He said, NemoClaw, this may be even bigger. I start my morning with NemoClaw. Could you explain to people why this may be what we're thinking about over the next 5 years and not something involving margins over the last 5 minutes?
Well, first of all, I said at the keynote, and I referenced a number I used previously because I want to give everybody a baseline.
We need that.
And so last year I said that about this point that we had $500 billion of high confidence visibility of Blackwell and Rubin. That's it. Obviously our company sells other things.
Right.
We have CPUs, we have storage processors, we have networking, and so we have all kinds of things that we sell in addition to that. We have $500 billion worth of visibility, and at this point, with another 21 more months to go to the end of 2027, we already have high confidence visibility of $1 trillion plus of Blackwell and Rubin. Not anything else, just Blackwell and Rubin. And so, we still have 21 more months of new orders coming in. Right. We still have all of the other things that NVIDIA sells. And so I just wanted to give everybody a baseline. The ecosystem needs to know directionally where NVIDIA is going. Now, of course, we plan with the supply chain. We help everybody with their capacity building. We prepare all the technology partners so that we can support $1 trillion worth of Blackwell and Rubin. And so it's an incredible thing.
You bought Grok in December.
Yeah.
What I heard yesterday, maybe my biggest takeaway, was that it's already going to be making you not money, but a huge amount of money, and that's not part of the trillion.
No. Yeah, we started production of Grok version 3. It's a really, really special company, and we're going to add Grok, not to every part. Vera Rubin is so incredible that it's really hard to add value to Vera Rubin. That engine is so incredible. And so, but there's some part of the workload, I think about 25% of the workload, where we could add Grok to it. And so for 25% of the workload, we could increase our opportunity even more. And so
people will be paying for this.
After watching this interview, it becomes very clear that this was not just another CEO talking about quarterly performance or short-term stock movement. This was Jensen essentially zooming out and telling you where the entire technology industry is headed over the next 5 to 10 years. And if you really listen carefully, there are a few moments in this conversation that should completely change how you think about Nvidia, AI, and even the broader market. Right at the beginning, there is this interesting contrast. The stock is slightly down on the day, and Jim Cramer brings that up almost jokingly, pointing out that Nvidia is up something like 22,000% over the last decade. And the question is basically, should anyone even care about a small move like that in the short term? Jensen's response is subtle but very telling. He says yes, Of course people care about the short term, but then he immediately pivots to something much bigger. He talks about how Nvidia's growth is actually accelerating at a larger scale, which is something that surprises people. And this is where I think a lot of investors still get it wrong. Most people assume that when a company gets this big, growth has to slow down. That is the traditional playbook. But Jensen is basically saying the opposite. He is saying that not only is Nvidia still growing, but the rate of growth is increasing even as the company becomes massive. That is not normal. And in my opinion, whenever you see something that breaks the traditional rules of business like that, you need to pay attention because it usually means there is a massive structural shift happening underneath. Then he introduces one of the most important concepts in the entire interview, which is what he calls the inflection of inference. Now this part is critical. Up until recently, most of the conversation around AI has been focused on training these massive models like ChatGPT, Claude, and others. That phase required enormous amounts of compute power, and Nvidia was the clear winner there. But inference is different. Inference is what happens after the model is trained. It is when billions of people and applications actually start using these models in real time. Every query, every request, every interaction is inference. And what Jensen is saying is that we are now hitting the point where inference demand is starting to explode. In other words, we are moving from building AI to actually using AI at scale. And in my opinion, this is where things get really interesting, because inference at global scale could be significantly larger than training. Training happens once per model, but inference happens continuously, every single second, across millions or even billions of users. So when Jensen says growth is accelerating, what he is really hinting at is that we are entering a new phase of AI demand that could dwarf what we have seen so far. Then Jim Cramer brings up something that I think reflects how a lot of people are still thinking. He mentions margins, short-term expectations, and near-term numbers. But then he pivots to something more forward-looking, asking Jensen to explain why technologies like Nemo and Claude could be even bigger than what people currently expect. And Jensen's response here is very calculated. He starts by grounding the conversation in numbers. He talks about how last year, Nvidia had about $500 billion of high-confidence visibility tied specifically to Blackwell and Rubin. Now just to pause here for a second, that number alone is massive. $500 billion of visibility is already enormous. But then he updates that number. He says that now, with about 21 months still remaining until the end of 2027, Nvidia already has high-confidence visibility of over $1 trillion, just from Blackwell and Rubin alone. Not the rest of the business, not CPUs, not networking, just those two platforms. That is an insane number. And what stands out to me is not just the size of the number, but the confidence behind it. He keeps repeating the phrase high-confidence visibility. That means these are not just projections or optimistic guesses, these are orders, commitments, and demand signals that Nvidia is already seeing from customers. And when you think about it, that changes the entire narrative, because a lot of the skepticism around AI stocks right now is based on the idea that demand might slow down, or that this is some kind of temporary hype cycle. But if Nvidia is already seeing over $1 trillion in committed demand before we even reach 2027, then this is not hype, this is infrastructure. This is companies, governments, and entire industries building out the backbone of the next technological era. And Jensen even explains that Nvidia is actively working with the supply chain to prepare for this level of demand. They are helping partners build capacity, scaling production, and aligning the entire ecosystem to support this growth. So this is not just Nvidia growing, this is the entire global tech infrastructure expanding around AI. And in my opinion, this is where the comparison to past tech cycles becomes really important. This feels less like a normal product cycle and more like the early days of the internet or cloud computing, where once adoption reached a certain point, everything accelerated at once. Then the conversation shifts to something that might have been easy to miss, but is actually very significant. Jim Cramer brings up Grok, and he mentions that it could end up generating a huge amount of money, and that it is not even included in that $1 trillion number. Think about that for a second. The $1 trillion visibility that Jensen just talked about does not even include potential upside from things like Grok. That means there are additional layers of growth that are not even being fully accounted for yet. And Jensen confirms that they have already started production of Grok version 3, and he describes it as a really special company. Now, what is interesting here is how he talks about where Grok fits into the broader ecosystem. He mentions that their existing platform, Vera Rubin, is already so powerful that it is actually hard to add incremental value to it. That is a fascinating problem to have. Imagine building something so advanced that improving it becomes difficult because it is already operating at such a high level. But then he identifies that there is still a portion of the workload, around 25%, where there is room for optimization and added value. And this is where I think Jensen is quietly revealing something important about how Nvidia is thinking. They are not just trying to build one dominant product. They are looking at the entire stack of AI workloads and figuring out where they can optimize, improve, and capture value across different layers. It is a very strategic approach. Instead of chasing every opportunity, they are identifying the exact segments where they can make the biggest impact. And in my opinion, this is one of the reasons why Nvidia has been so successful. They are not just reacting to trends, they are shaping the direction of the industry. Another thing that stood out to me in this interview is how Jensen consistently tries to shift the conversation away from short-term thinking. Every time the discussion starts to move toward daily stock movements or near-term metrics, he pulls it back to long-term trends, infrastructure, and ecosystem development. And I think that is intentional. Because if you focus too much on short-term noise, you completely miss the scale of what is being built. We are talking about trillion-dollar infrastructure, global demand for AI compute, and a transition from training to inference that could multiply usage exponentially. That is not something you evaluate based on a single trading day or even a single quarter. And honestly, this is where I think a lot of investors get shaken out too early. They see volatility, they see headlines, and they lose sight of the bigger picture. But if Jensen is even partially right about the scale of inference demand and the level of visibility Nvidia already has, then we are still in the early innings of this entire trend. Now that does not mean there are no risks. There are always risks. Competition, regulation, supply constraints, and changing technology landscapes can all impact how this plays out. But what this interview makes very clear is that the demand side of the equation is not slowing down. If anything, it is accelerating, and that is the key takeaway. We are not just in an AI boom, we are in the early stages of an AI infrastructure build-out that could define the next decade. And Jensen Huang is essentially telling you that Nvidia is positioned right at the center of it. So when you hear people debate short-term price movements or question whether the hype has gone too far, it is worth stepping back and asking a different question. Are we looking at this the wrong way? Because if the numbers he is talking about are real, and if inference demand scales the way he expects, then this is not just another tech cycle. This could be one of the biggest platform shifts we have seen in a long time, and the reality is, most people probably still do not fully understand just how big this could become. Now let's dive into the 2 tech stocks to buy now if you feel like you missed the Nvidia run. The first stock is Marvell Technology, ticker symbol MRVL. Now before we even talk about numbers, you need to understand why this business matters. Marvell is not a consumer-facing company. It is not flashy. It is not something you see in headlines every day, but it sits at the core of one of the most important shifts happening in technology right now, and that is the explosion of data infrastructure driven by AI. Every AI model, every cloud service, every data center expansion relies on one thing: high-speed data movement and processing. And that is exactly where Marvell dominates. This company designs the chips that allow data to move faster, more efficiently, and at massive scale inside data centers. Without this layer, AI simply does not function at the level we are seeing today. And this is why I personally think Marvell is one of the most misunderstood opportunities in the market right now. Most people chase the obvious winners, but the real long-term gains often come from the companies that are quietly enabling the entire ecosystem. Marvell is one of those companies. Now let's talk about what is actually driving the business. The biggest growth engine for Marvell right now is data center demand, specifically tied to artificial intelligence workloads. As companies build out massive AI infrastructure, they need specialized chips to handle networking, storage, and data transfer. This is not optional, this is required, and Marvell is positioned directly in that demand cycle. According to recent updates, the company has been seeing significant acceleration in its data center segment, with AI-related revenue becoming a larger and larger portion of its overall business. What is interesting here is that this is still early. We are still in the early stages of AI infrastructure build-out. Companies are still investing heavily in capacity. Governments are getting involved. Entire industries are shifting toward AI-driven operations. That means the demand for Marvell's technology is not a one-time spike. It is a multi-year trend, and this is where the compounding potential comes in, because once these systems are built, they need to be upgraded, expanded, and maintained. That creates recurring demand over time. Now let's talk about the numbers, because this is where things get even more compelling. Marvel has been transitioning its business toward higher margin, higher growth segments, particularly data centers and custom silicon solutions. This shift is important because it improves both revenue growth and profitability over time. The company has also been focusing on custom AI chips, which is a huge opportunity. Instead of just selling standard products, Marvel works with large customers to design chips tailored to their specific needs. This creates deeper relationships, higher switching costs, and long-term contracts, and that is a powerful moat. Because once a company builds its infrastructure around your technology, it becomes very difficult to switch to a competitor. In my opinion, this is one of the strongest competitive advantages a company can have. Now, from a financial perspective, Marvel has shown strong revenue growth tied to this AI demand, and management has been very clear that data center revenue will continue to expand as a percentage of the business. Margins are also expected to improve as the mix shifts toward these higher value products. And this is key, because when you combine revenue growth with margin expansion, you get operating leverage. And that is where earnings can start to grow much faster than revenue. That is how you get those exponential stock moves over time. Another thing I like about Marvel is that it is not trying to do everything. It is focused on specific, high-value areas of the market where it can dominate. Networking, custom silicon, data infrastructure. That focus allows the company to allocate capital efficiently and build expertise in areas that matter most. And when you look at the long-term trend of data growth, it is clear that this is not slowing down. We are generating more data than ever before. AI is increasing the amount of data being processed. Cloud computing continues to expand. All of this requires better infrastructure, and Marvel is right in the middle of it. Now, of course, there are risks. The semiconductor industry is cyclical. Demand can fluctuate in the short term. Competition is always a factor. But the key question is not what happens next quarter. The key question is where the industry is heading over the next 5 to 10 years. And based on everything we are seeing, the demand for AI infrastructure is only going to increase, which puts Marvel in a very strong position. Now, here is something that I think a lot of investors overlook. When Nvidia sells GPUs, that is just one part of the system. Those GPUs need to be connected, they need to communicate, they need to move data at extremely high speeds. That is where companies like Marvel come in. So in a way, Marvel benefits from the same trend that is driving Nvidia's growth. It is just one layer deeper in the stack, and sometimes those layers can be just as valuable over time. Now, before we move on to the next stock, let me say this. Marvel is not a get-rich-quick stock. This is a long-term play on one of the most powerful trends in technology. And if the AI infrastructure build-out continues the way it is expected to, this company could be a major beneficiary. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the second stock, and this one is much more well known, but I think the opportunity here is still being underestimated. The second stock is Alphabet, ticker symbol GOOG. And before you dismiss this as a boring mega cap, you need to understand something. Alphabet is not just a search company anymore. It is one of the most powerful AI platforms in the world, and I would argue that it is one of the most important companies shaping the future of how information is created, distributed, and monetized. Now think about this. Alphabet already owns one of the largest data ecosystems on the planet. Search, YouTube, Maps, Android. These are not just products, these are data engines. And in the age of AI, data is everything, because the more data you have, the better your models become. And that is a massive advantage. Now combine that with Alphabet's investments in AI, and you start to see the bigger picture. The company has been aggressively integrating AI into its core products, improving search, enhancing advertising, and creating new revenue opportunities. And this is where things get really interesting, because AI is not just a cost for Alphabet, it is a growth driver. By improving search results and user experience, Alphabet can increase engagement. More engagement leads to more ad revenue. At the same time, AI allows the company to create entirely new products and services. And this is something that I think the market is still trying to fully understand. Alphabet is not just defending its existing business, it is expanding it. And when you look at the financials, this becomes very clear. The company continues to generate massive cash flow, which it can reinvest into AI, infrastructure, and new initiatives. This gives Alphabet a huge advantage over smaller competitors, because it has the resources to invest at scale. And scale matters, especially in AI, where the cost of development and infrastructure is extremely high. Now, another key point here is valuation. Compared to many other AI-related stocks, Alphabet is still trading at a relatively reasonable valuation, and this is what makes it interesting. You are getting exposure to AI growth, but without paying the extreme premiums that you see in some other names. In my opinion, this creates a favorable risk-reward setup, because you have a strong, established business generating consistent revenue, combined with new growth opportunities driven by AI. That is a powerful combination, and I think this is where a lot of investors might be underestimating Alphabet. They see it as a mature company, but in reality it is evolving, it is adapting, and it is positioning itself for the next phase of technology. Now, one thing I want to highlight is how Alphabet approaches innovation. This is a company that invests heavily in research and development. It is constantly experimenting, building, and refining its technology. And while not every project succeeds, the ones that do can have massive impact. That is how you get products like YouTube and Google Cloud. And now AI is the next frontier, and Alphabet is going all in. Now, if you step back and look at both of these companies together, you start to see a pattern. One is building the infrastructure that powers AI. The other is building the platforms that use AI. And both are positioned to benefit from the same long-term trend, which is the increasing importance of artificial intelligence in every aspect of our lives. And this is why I think these two stocks are so compelling right now. They are not just riding the AI wave, they are helping to shape it. One of the biggest misconceptions about Alphabet is that it is a one-dimensional business driven primarily by advertising. And while advertising is still the core revenue engine, what matters more is how that engine is evolving with AI. Alphabet is not just improving ads, it is fundamentally changing how ads are created, targeted, and delivered. With AI, the company can better understand user intent, predict behavior, and optimize ad placement in real time. This leads to higher conversion rates for advertisers, which means they are willing to spend more, and that creates a powerful feedback loop. Better AI leads to better results for advertisers. Better results lead to higher spending. Higher spending drives revenue growth. This is not just incremental improvement. This is a structural upgrade to the entire advertising model, and in my opinion, this is one of the most underappreciated aspects of Alphabet's business. Because when people think about AI, they often focus on new products, but sometimes the biggest impact comes from improving existing products at scale, and Alphabet has one of the largest existing platforms in the world. Now let's talk about Google Cloud, because this is another major growth driver that cannot be ignored. Cloud computing is becoming the backbone of modern business operations. Companies need scalable, flexible infrastructure to run applications, store data, and now, to deploy AI models. And Alphabet's cloud business is growing rapidly as more companies adopt these technologies. What makes Google Cloud particularly interesting is its integration with AI. Alphabet is not just offering cloud storage or computing power. It is offering AI tools, machine learning platforms, and advanced analytics that businesses can use to build their own AI solutions. This positions Google Cloud as a key enabler of the AI economy. And as more companies invest in AI, demand for these services is likely to increase. Now, from a financial standpoint, Google Cloud has been moving toward profitability, which is a significant milestone. For years, it was seen as a heavy investment area, but now it is starting to contribute meaningfully to the company's overall earnings. And this transition is important, because it shows that Alphabet can invest in new growth areas while still maintaining strong financial discipline. Another factor that I think is worth highlighting is Alphabet's balance sheet. The company has a massive cash position which gives it flexibility. It can invest aggressively in AI, it can acquire new technologies, it can return capital to shareholders through buybacks. And this financial strength reduces risk, because even if there are challenges or delays in certain areas, the company has the resources to navigate them. Now let's talk about something that I think is critical when evaluating long-term investments, and that is competitive positioning. Alphabet operates in highly competitive markets: search, cloud, AI. But despite this competition, the company has maintained a dominant position in several key areas, and that is not by accident. It is the result of years of investment, innovation, and ecosystem development. For example, in search, Alphabet benefits from network effects. The more people use the platform, the more data it collects. The more data it collects, the better its algorithms become. And the better its algorithms become, the more people continue to use it. That is a very difficult cycle for competitors to break. And now, with AI integrated into search, that advantage could become even stronger, because AI allows Alphabet to deliver more personalized, more accurate, and more useful results. And that enhances user experience. Now, I want to share my personal take here. I think a lot of people are underestimating how quickly AI will become embedded into everyday products. This is not something that will take decades. This is happening now, and companies that already have massive user bases and data advantages are in the best position to benefit. Alphabet is one of those companies. Now let's bring everything together and compare both stocks. On one side, you have Marvell Technology, a company focused on the infrastructure layer of AI. It benefits from the increasing demand for data movement, networking, and custom silicon. It is positioned behind the scenes powering the systems that make AI possible. On the other side, you have Alphabet, a company focused on the application layer of AI. It uses AI to enhance its products, improve user experience, and drive revenue growth across multiple platforms. And both are connected by the same underlying trend, the expansion of artificial intelligence. Now the question becomes, which one has the stronger long-term advantage? And this is where I want to hear from you. Do you think the infrastructure side, represented by Marvell, has more upside because it is earlier in the growth cycle? Or do you think the platform side, represented by Alphabet, has the edge because of its scale, data, and ecosystem? Let me know your thoughts in the comments, because this is not just about picking stocks. This is about understanding where value will be created in the next phase of the AI revolution. Now, before we wrap up, let me leave you with this. The biggest opportunities in investing often come from identifying long-term trends early and positioning yourself accordingly. AI is one of those trends, and while Nvidia has captured a lot of the attention, it is not the only way to participate. There are other companies, like the ones we discussed today, that are deeply embedded in this transformation. And in some cases, they may offer even more attractive opportunities, depending on your investment strategy. The key is to focus on businesses with strong fundamentals, durable competitive advantages, and clear growth drivers. And both Marvell and Alphabet check those boxes. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.